Now presenting President and CEO Cameron Watt for Intouch Insight.
Thank you. Hello, everybody. Hope we're enjoying the conference so far. I will go through a bunch of standard slides here. I'll go through them pretty quickly. Some of you may have seen some of them before. Some of them are updated. Some of them are new. But I'll try to leave time more at the end in case anybody has any questions or want to engage that way. I'll let you memorize that. Everybody put their hand up when your legal's got it covered. You good? All right. We've been around since 92. We've been traded since 02. We effectively look after brand health for companies. We do that through services and software. If you think about a Wawa, a Burger King, whatever, they have a lot of locations, anywhere from hundreds to thousands that need to maintain the exact same standard or very close to it across a large environment, including franchisees, corporate managers. We make sure that that's happening. Board of directors is fairly small, 5 of us, myself as a board member as well. Eric Butel, who's a fairly familiar name in Toronto, he's our chairman. And we've got about 25 million shares outstanding, so very low float. We are currently trading at a very low market cap of 11 million. Eric and I are the 2 largest shareholders. I was the largest shareholder, but full disclosure, I'm not a founder. I wasn't around in 92 when it started. I didn't get any grants or penny stocks. I didn't dilute myself down. I bought all my shares in the open market. And so when I started buying them, I didn't think I would own as much as I do. And so I've got a whole, what they call a crap ton inside tax-free vehicles, and I'm not allowed to own more than 10% of the company or I have very bad things happen. So Eric doesn't have those problems, so he's now the largest shareholder, and I'm 9.9 something, which is what I maintain. Again, you can tell by the industries I talked about, it's QSR, it's restaurants, it's your petro-convenience, your grocery, automotive. It's places where there's lots of those things out there that are really our client base. We do that through a customer experience platform, which has a number of components to it. We do bread and butter is really on the services side, and that's what makes us different than some really big competitors. We actually physically go to every single location to check and see how they're doing. We do that through covert activities, which is often called mystery shopping, as well as overt activities, which are types of audits. And then we also have software products attached to that for customer voice of the customer programs, those annoying QR codes that everybody gets. We also do the forms and checklists software where people can do it for their own operations. And we started building that software business back in 2017, which we'll talk about a little bit later. And we combine it. But our software, we compete with people, for example, like Qualtrics and Medallia, right? These are billion-dollar companies with like hundreds of $1 million in marketing. We don't try to compete toe-to-toe. We use our services abilities, our services pedigree, where we are one of the big players, and we use that to get them to buy our software. Wawa, for example, buys our software and our services. But that's because I get treated like IBM. The old saying, you don't get fired for picking IBM, which really means don't pick some small unknown vendor, especially if you're a big company, because you could get in trouble if it doesn't work out. Well, once they're my services client, I'm IBM. And I'm now in the mix for everything. So we do a lot of cross-sell, and that's how we're building our software portfolio without having to spend the $300 million and have a burn rate. Been around a long time. We've acquired a number of companies over time, which is something that we tend to continue to do on an accretive basis. Obviously, on the services side, software is not accretive for us at the multiples we're trading at. And we do a lot of the top chains that are out there. Your 7-Elevens of the world and your Coca-Colas of the world are customers of ours. I'm not going to go through the slide in a big way, but really, like I said, these are multi-location businesses. They're interested in their brand standards, their customer service standards, and how they can keep their customers, and that's what we help them with. Does this come through in the audio? Who's in the charge back there? Does this play at all on your side?
Why? How do I increase my sales and my business? And that's really what they helped us to do throughout this entire process.
The pain point that Intouch solves uniquely well is a very robust and professional approach to large-scale sampling. Intouch has the ability to go out into the field and gather that information about how we should go forward.
Partnering with Intouch Insight was an incredibly powerful decision. It absolutely created an extra layer of value in our business model.
By putting this program in place and the focus around late night, we've seen an overall increase in sales from 3 to 5% all day growth. If we break out the late night day part, one of my markets has been up over 40% year over year. That is incredibly important to us.
Before Intouch, we had a different mystery shop provider, we had a different audit tool, so you have to go source the information from different areas. Really having all that information in one repository makes it very easiest for access to data and get the information we require.
Intouch made launching all the programs super easy. The training that they provide and the patience that they've given us to go through and learn the processes. I would say flexibility and training are their two strongest suits. They were extremely professional. They were extremely knowledgeable. They were extremely capable of all the things that we went to them and asked for. They were able to produce and quickly turn around.
My experience working with the Intouch Insight team has been nothing other than 5-star. And Intouch Insight was absolutely one of the best decisions I've made in the last year.
I put that up only because when the CEO stands up and says, our customers love us and we actually provide a value, that's, it's believable, but we're all saying it, right? That's just a handful of customers. The other data point that I always like to give in terms of whether, our business is viable or whether it's needed is when the pandemic hit, we lost 70% of our revenue the next quarter. Because think about it for a second. These guys didn't need me in there, right? You want to know if people are happy? People are wearing masks, right? Nobody's happy. Right? Was the customer service in your location good? No, it was terrible. But they didn't need me in there telling them that. And so the only reason it wasn't more than 70, by the way, was because of my software and some of my event marketing and other business lines, which kept the lights on. But after that, these guys have now all stopped their programs. They no longer have tracking. They no longer have history, right? They could just shut her down. They didn't. They came back, right? We are now doing more revenue than we were doing pre-pandemic, right? So there is a need for what the thing is, which is the cool part. We also do a lot of thought leadership out there in the industries that we serve, primarily focused on the QSR and petro-convenience industries, which are two of our largest, and we're adding a third one this year from a thought leadership standpoint. We do studies that are picked up. In fact, my marketing director just sent me a link this morning to we were referred to in a Harvard Business Review article that was just published, and one of our studies was referenced in there. We are referenced on major news outlets all of the time for the work that we do. I personally present on very large stages full of hundreds of people in the industry a couple times a year. And these are not pay to play. We're not paying to get things published. We're not paying to get speaking slots. We're invited to go. We go because of the studies and the expertise that we're providing, the information that we provide the industries. So we've really honed in on that from a marketing standpoint on the thought leadership side of the people that we serve. Historical milestones, if you take a look, I joined the company back in 2011 in sales and marketing. I took the title of president and CEO in the fall of 2013. So that's why my chart starts in 2014. From there, we've grown the business consistently. We've had some ups and downs as it relates to factors outside our control, like global pandemics. If you go back to 2020 in February, I was the most optimistic guy you're ever going to meet. I was literally, we were 70, 80 cent trading price at the time, and we're going up. I had another acquisition lined up for May 1st, and then the rug got pulled out, right? We built it back. Last fall, we issued last spring, I came out and said we were going to grow exponentially, a big growth, but we weren't going to make more money because we were going to go buy a bunch of volume in a new segment. All you folks in the room in the market said, yeah, that is so last year. We don't want that anymore. We would like profits instead because we only want to make sure that there's cash flow. So we retacked this time last year and turned the attention to profitability, and you'll see in our numbers later, we did that. We turned almost $1 million operating profit last year after switching gears, and just slowed the growth down to do it from where we were investing. And so we were able to do those types of decisions, but yet, and then we released really good information, I thought, in Q3. The stock was trading up in 65 cents or so, hundreds of thousands of shares moving around that number. Q4 rolls around, first week of April. I release year-end results from last year. They're better than my Q3, frankly. Really good release in terms of financials and information. Stock is down trading in the mid-40s, right? Why? We all know why. The macroeconomic environment in the market right now, in microcap, is not great, right? Which is not great in terms of if you're in my shoes. It's great if you're a stock picker. So it depends on which side of the fence you're sitting on, whether you got cash whether you're sitting on cash or whether you're, sitting in stock that all went down. But it's just the markets that we're in. Again, we acquire things on a very regular basis. My acquisition strategy is what I've always referred to in my releases as opportunistic acquisition. We are not diluting. We're not going to get shares from people to do this. We're not, we're not doing it on some massive roll-up strategy, but there's always opportunities to buy something. And we've always found those opportunities, make sure they're accretive, and we can tuck them in. Financially, if you take a look, that's, you can see that pandemic dip that we talked about, and then we've had the revenue recovery. If you take out the dip, it's been a pretty much up and to the right graph. We've been EBITDA positive. Even through the pandemic, we managed to maintain EBITDA positive. With a 70% revenue loss in Q2, we were EBITDA positive, right? Financially, the business is very secure, and we can make a lot of very quick changes. The only time we ever were negative EBITDA was intentional, and we'll get to that when we talk about a raise later, where we actually went into the software business. And that's what you see there as well, is that we did the only capital raise we've ever done was in 2017, since going public, was in 2017. That was when I raised $3.5 million to get into the SaaS business, which we raised it, spent it, and got into the SaaS business. Last year, we did $1.6 million in SaaS and another $1 million in event marketing software. So we got into the software, which, by the way, I was really happy that I did this when the pandemic hit, because that was that 30% of the revenue that I kept. We're rolling along with a lot of that was software, right? And then we went to focus on survival and recovery when the pandemic hit. And then we were focusing on growth as we started the year, and we had to switch, as I talked about, to focusing on profitability. So our financials, they're not being done to us. We are deciding what we want to do with investment levels and profitability levels, because it's a very stable, solid business. And if you look at the share history, there's only been 2 events, I would call them, as it relates to shares, since I've been around. Well, actually, since we went public, because they never did anything before me. And that would be a capital raise I talked about in 2017, which was to get into that software business. And the other one was issuance of our RSUs, which were in 2021. I believe we issued, well, they got done in 2021. What that was we had a number of employees, in order to stay EBITDA positive and stay in business, but keep your talent. We had a lot of people who were very loyal. A lot of our employees did not get paid, or they got paid at a reduced level, including myself, for that time period. In fact, I took a 50% pay cut on retroactive to March 1st, as soon as the pandemic hit. And then we cascaded that mentality down to make sure the company was going to be okay. We then rewarded the people who stayed with us and didn't get paid or took a less pay. We gave them restricted share units, but they had to stick with us for another full year from that fall. So it also formed a retention thing. And those are the only 2 events we've had, really, as it relates to any significant amount of shares. And that's why we're only sitting at 25 million shares today. So when you look forward, we are going to pursue new sources of revenue, right? Got to. We're also looking at AI right now, and I've announced this. And we found 3 areas so far. We're currently working with some partnerships. Am I going to be developing my own AI? No. I mean, OpenAI is out there, right? But there's a lot of ways you can take the LLMs and you can take what's out there and you can turn it into advantages for yourself. And we've identified areas both in the operational side of our business where we get people, where we get those thousands of people to do the thing that they do on a regular basis out there. Interacting with them, we can be using AI, as well as how we would get reporting and analytics to our customers can be using AI. So there's a number of ways that we're looking into that right now. We're obviously, cost efficiency is going to go with that, and we're going to continue that thought leadership piece. Those are some of our key focuses. In terms of the value, we're trading at, 0.4 something right now, times of revenue, right? We'd have to be at $1 just to be at 1 times revenue. And that's on core revenue. That's not including the Ardent business, which was $3 million last year, roughly, of revenue was in Ardent, it's called. That was the thing I was going to grow to 20, 30 million but not make a lot of money while I was doing it. And we shut her down. So I look at the core revenue of 25 million last year, and it's 25 million. 25 million is not hard math. It's $1 a share, right? We're currently trading at 44 cents last time I looked this morning. SaaS revenues, by the way, this is a little gem underneath the covers. It's growing because we're selling it to our existing customers I talked about. We don't spend money on AdWords. I don't have a burn rate. I don't know how many SaaS companies you're aware of that now do $1.6 million and sell to people like Wawa and Petro-Canada, right? And I don't know how many people can say that didn't have a burn rate and don't have, a whole lot of dilution that happened to get there. We bootstrapped it inside the services company, and other than that one raise, and we're continuing to do that. So, and if you look at 7 times revenue on last year's SaaS is worth more than my entire market cap right now in terms of value. Our tenure, just for perspective, quarter of our employees have been with the company for 10 years or more. And half of the employees have been here for more than 5 years. That goes before the pandemic. That's that loyalty I'm talking about, people stuck with us. So that's great knowledge base. And we've also, of course, got new blood because you need that. So, bottom line, I think there's a pretty compelling argument here in terms of where our valuation should be. I will mention that we don't do a lot of IR. I do this conference once a year. Some of my shareholders are here. I do one in Canada where a bunch of shareholders attend. And that's it right now. We were doing IR pre-pandemic. We shut it down. We have not turned that machinery back on yet. At some point, we'll have to turn our attention there. But right now, we are still hyper-focused on creating the value. And, whether there's different philosophies, certainly, in terms of CEOs and how people manage things. My belief, whether it's ill-begotten or not, is that if I spend my time creating inherent value, then my shares and my retirement is going to be protected, because as long as there is true and real value, I can go get that. Whether that's through IR activity at some point to get things really rolling, whether that's through a different type of exit, I know if I have true value that's really really worth something, I can go get that money. That money is going to be there. What I don't want to be doing is pumping the stock and getting things going and getting things moving. Some people make money as they come in and out, and I wind up chasing the value of the company instead of creating value in the company. And so we're currently creating value again, but we will be turning our attention at some point to the IR, mostly because, frankly, a much higher multiple would be nice to be able to do M&A, right? As a public company, I should have access to capital markets, but I'm not diluting at 44 cents. I'm not diluting at 54 cents. So that's the only reason that we'll have to get things moving at some point. But today, we're still really focused on the business side. And with that, I got a thank you slide up, which means we got a few minutes for questions. No, we actually put an NCIB in place back in, I think I put one in place in 2013 or 2014, and we ran that for about 3 years. We stopped the last NCIB we stopped because we went and did the raise in 2017. And I felt a bit like it was odd to be buying our own shares and doing a capital raise in the market at the same time. So we shut the NCIB down before we did the raise in 2017. But we did do it then on a limited basis as well. We did it, yes, that's a good point. We issued a release yesterday that we've got an NCIB, we're putting one in place as soon as all the paperwork and various things can flow through. And that's because I'm honestly tired of looking at the share price the way it is, and I can't buy any because I'm at my legal limit.
Let's say, as you're buying stock, then, as the company's buying stock, then you're kind of forced to sell if you're at 9.99 or like your.
I've got a little bit of room. I could wind up in a situation where I have to sell. There was one, when we had the last NCIB in place, one spring, I did have to sell 30,000 shares or 40,000 shares because my CFO came and told me she was doing the circular and I owned over 10. So that could happen. I could have to exit some shares, but I still think we have the cash flow. It's an accretive move for the shareholders, and I'm tired of looking at a price of shares I can't buy.
In terms of the SaaS business, what are you planning to do to the market to see the value of that lake?
What am I planning to do to the?
To show the value of that lake.
Well, currently it's not currently, a standalone SaaS business with, hyper growth. So we haven't yet identified that as a separate item. As we continue to sell to our current clients, once we get that 1.6 and can get it on a bit more of a growth trajectory, which is what really the goal is right now, as opposed to focusing on the market. It's on the business side. It's getting that 1.6 and making that 2 and then 3, getting a little bit more of a growth curve going with our existing clients on it. And if we can get that going, then I think we've got something we can talk about separately. The core business really, I would have told you I thought it was going to happen right now. The macroeconomic factors have hit us a little bit. Last year we had, America holds their breath every 4 years for 1 year, right? And then when the election cycle's over, things, no matter who wins, there's some level of certainty and business starts again, right? Business didn't start this time. right? The uncertainty actually accelerated, it did not decline. And so our customers, a lot of them who have programs that they're ready to go, or they want to do this, they're going to add this, they're all going, well, we're going to wait, right? So we're going to sit tight. So some of it has to do with just macroeconomic, our customers being really big companies, when are they going to spend that extra $1 million or going to do that extra program, right? So that's part of it. It's a bit of combination of sales and marketing type of resources as well. Like how much money do you want, how much log do you want to throw in the fire? And right now we're balancing the concept of profitable growth. And so, we were, yeah, we're not going to use much for that though. We don't expect it to cost very much. I mean, the prices we're going to be buying it up, we're not, and you can't buy more than 5% in a year, right? So it's not going to eat a lot of cash. And that would be, and that's a cash, and it doesn't affect the profitability on the statements. So they're not really competing. But that was a great question. My board asked that question.
I wonder how the business has changed since QSRs are now using apps and kiosks for ordering. Has your business changed at all?
No, well, yes and no. I mean, fundamentally no, but it's actually got more interesting. For example, one of our studies we've done recently was exactly on that, on the new QSRs, on the double drive-throughs, on the using the apps to order, on using in-store, because now you can buy online and pick up in-store. You can have third-party delivery. Like that's what we've done, third-party delivery studies, kiosk studies, technology studies. So it's actually opened up in terms of things we can go and look at and research. And the same thing for the brands. There's more things they now need to monitor and measure. They're no longer just measuring was it drive-through or takeout, order, right? Now they've got third-party delivery, first-party delivery, pickup at the curbside pickup. They've got, some of them have boxes you can pick it up at. So there's all kinds of stuff like that. I think I have time for one more question. If there are any, if not.
How do you expect margins to change as the business continues to grow? Do you find margin profiles quite linear, or do you go kind of operating leverage?
We have operating leverage. And it's funny, I've often said, if you look at, it looks like we're, if you're coming out of business school and you looked at the revenue doing this and the EBITDA doing that or profits doing that, you'd be like, oh, they have no operating leverage because, that's what all the business theory says. That's just us making decisions, right? So what happens with that is a lot of us making decisions on how we deliver and how we execute. But we actually get operating leverage whenever we add any type of program. And as we sell software, that is huge. That's huge operating leverage and margins on the software side. So yeah, we do get that as we grow. All right, with that, hope everybody has a very productive conference. Thank you, everybody.